Okay, welcome, ladies and gentlemen. Great to have you join us for our webinar, IMFS webinar together with the IMF, in a sense, because we're going to take a very close look at a research paper coming out of the International Monetary Fund. My name is Volker Wieland. I'm managing director of the Institute for Monetary and Financial Stability here in Frankfurt. I'm delighted to have three experts join us. Normally, I would say ladies first, but let me first start with the author or co-author of the paper. So we have Nier from the IMF. We have then Cornelia Holthausen from the ECB and Steve Cecchetti from Brandeis University. I will very, very briefly introduce them in a moment. But just in terms of the organization, let me say a few things for all the participants. Basically, the way our setup works, you will see the four of us with picture and everything. So we're going to try not to scratch ourselves in the nose or whatever, do anything embarrassing. We will also be recorded actually, and so we can post this later. You're not visible, the other participants, but you will have access to the Q&A tool. So it's a good time to check out whether you have the Q&A tool in your Zoom. Down there, it's Q&A or F&A in German. But when you click there, then you can already during the talks write in your questions. And then when we get to the Q&A, I will read your questions. And so that basically it will also be vocally recorded in our recording, and then we can have our speakers, our panelists, to respond to them. So please think already now of, as we go through the presentations, what you want to ask, and then keep writing it into the Q&A tool. If it's okay with you, I will mention your name when I read the question, because many of you are good friends and experts we know and have interacted with in the past. So briefly to our panelists, Nier holds a PhD from London School of Economics. He's worked at the IMF for a long time. He's also for many years been the deputy division chief of the division on monetary and macroprudential policies. So both on the research side and the practical policy side, he's been heavily involved with the topic. Currently, he's an advisor, holds an advisor position in the Monetary and Capital Markets Department of the IMF, which is, of course, dealing and advising many countries on the application of macroprudential policies. And we'll hear from you about, what you think, and you have a co-author, what you think about basically the macroprudential capital buffer and how it should be used, and what we have learned from the use in previous periods, in particular also the Corona recession period. Then we will have Cornelia Holthausen from the ECB as a first responder, giving the impressions and experience and also research input from the ECB, the European Central Bank here in Frankfurt. Cornelia holds a PhD from Pompeu Fabra in Spain, University of Pompeu Fabra in Spain. And she has also actually looks back at a long career at the European Central Bank. In the research side first, then also in the policy side. She now holds the also very important influential position of being Director General of the Macroprudential Financial Stability Directorate General. So she's really dealing with these issues very intensively. And finally, we have Steve Cecchetti, last but not least, from Brandeis University, academic, but also highly experienced on the policy side. He's a frequent commentator, but also a researcher with influential publications on the topic of financial stability. But on the policy side, he has also been chief economist or head of research and vice president at the New York Fed at some point, and then afterwards chief economist at the Bank for International Settlements in Basel. It's been very close also to the Basel process, and we're keen to hear your views. So without further delay, I hand over to Erland. I'll come in later on to moderate the Q&A. So Erland, please go ahead, share your slides. You have a few slides. You mentioned that, and we'll be keen to listen to you.
Yeah. Thanks. I hope this is the right version.
Okay, we can see it. It's not quite in the presentation modus, but even if not, we can see it fine. Now it's in the presentation modus.
This
So
should
please
work
go
now,
ahead.
right?
Yeah, perfect.
Okay. Yeah, great. Thanks so much, Volker, for inviting me to this webinar. This paper, Rethinking Macroprudential Capital Buffers, as you said, is joined with Paavo Miettinen. We're both at the IMF. The usual disclaimer applies. The views are those of the authors rather than the IMF, its executive board, or its management. We're talking about a rethink for the way we use macroprudential policy tools, and it leads towards more preemptive use of these tools relative to the framework that had emerged just after the global financial crisis. So that rethink is ongoing, and it includes the use of macroprudential capital buffers. Specifically, in the wake of the COVID pandemic, the Basel Committee has supported countries that adopted a positive neutral countercyclical capital buffer, CCYB, as opposed to keeping that buffer at a zero rate unless credit growth is excessive. Our work points to benefits of such an early activation of releasable buffers more generally to neutral rates for both advanced and emerging economies. And just to define some terms here, releasable buffers refer to those where the ex ante design and the communication explicitly foresees the possibility of a release in stress periods. So the CCYB is an important example of that, but may not be the only releasable buffer that you can imagine. Early activation refers to this preemptive use of the buffer outside of periods of excessive credit growth. And neutral rates are just those that are useful even in the absence of elevated cyclical risks. In line with some of this rethink that's underway, the IMF has already recommended positive neutral rates for releasable buffers in the majority of the recent FSAPs. And indeed, positive neutral rates are in place already also in a large number of countries. The UK has essentially started that movement back in 2016. They have always had a neutral rate, and more countries are coming into the set over time. Most recently, for example, Chile, the UAE has introduced neutral releasable rates. In this presentation, I want to just briefly give you, answers to the following 5 questions. First, how do we want to use these releasable buffers? I'll talk about 3 decision points. You want to activate early, then potentially tighten so that you are in a position to release the buffer. Second, why is this a good idea? Third, how big should those neutral buffers be based on stock vulnerabilities and potentially stress tests? Finally, who should have positive neutral rates? We argue that it's the EMEs, the emerging market economies, as much as the advanced economies. And then finally, I'd like to talk a little bit about different designs of buffers and sort of complementary mechanisms. So this chart essentially tells you how we want to think about using the releasable buffers. It's easiest to start towards the right of this chart, where you have the red period, or the red bar indicating stress. So in a stress period, you have the release, when the supply of credit is constrained by the stress. So capital becomes binding as a result of stress. That can be put for two reasons. One is the banks see solvency issues in the future, and that eats into capital that's available to lend. But also, it could be that in stress periods, corporates and households are demanding more credit to tide them over, and that also leads to the capital requirements becoming more binding. In those stress situations, then it's very useful to be able to release the capital buffer to help banks meet the demand for credit. As then the stress abates and we move through a recovery phase, that's the left, we're going towards the left of this chart. The idea here is that we start reactivating the releasable buffer early, as soon as banks are becoming more profitable or building a voluntary buffer. So we're not waiting until credit conditions are sort of exuberant with that activation. On the other hand, of course, we can also increase the buffer further beyond the neutral rate in the event that risks are assessed as elevated. And so here in the chart, the neutral rate is the 2% that's reached already relatively early. Why is this a good idea? A positive neutral rate recognizes that it's very difficult to predict periods of aggregate stress. The pandemic served as a reminder that adverse shocks need not be preceded by excessive credit developments and can arise more exogenously. The positive neutral rate affords a baseline level of protection against those aggregate stresses. It generates policy space for the release to support the provision of credit to the economy in adverse conditions, including from external or other exogenous shocks. And it can also be built upon, of course, when risks are deemed to be further increasing. So that's the basic idea. Theory that we have available points to net benefits of maintaining releasable capital buffers at a neutral level in normal times. And I'd mentioned a paper by the ECB and the Bundesbank that is nicely setting out this theory. Again, the idea here is that the release of capital buffers in periods of stress is useful because it generates additional headroom that banks have on top of any other capital requirement that they need to meet. So we're essentially increasing the voluntary buffer that banks have on top of these other requirements. And that makes it less likely that banks will need to cut lending as they approach those other requirements as a result of the stress, right? As a result of losses and so on. They approach these other requirements absent the release, they would have to retrench, deleveraging processes will set in. The release helps them continue the provision of credit through the economy. So that's the benefit to avoid deleveraging. On the other hand, the costs of increasing these buffer requirements gradually and in normal times are quite low because they will only affect the price of credit through a pricing channel. Evidence has become available that supports these ideas. Evidence on the effectiveness of the release is consistent across countries. And it's also quite well identified. The studies are finding that the benefits of the release for the provision of credit is greater for banks that sit closer to the other remaining requirements, so that have more to gain from the release, and also for exposures that are less subject to other fiscal support mechanisms. So we find that the studies here can reasonably well identify the benefit of the release, and the studies are consistent across countries, Euro area, UK, Hong Kong, the EU as a whole, for the COVID period, but also they're consistent with earlier evidence around the GFC, the global financial crisis. The experience and the evidence shows, though, that buffers need to be designed for the release in periods of stress for this to work, and that the release needs to be really well communicated as well. So what we found is that encouraging banks to use other types of buffers that aren't specifically releasable, such as the capital conservation buffer, or in the United States, the so-called stress capital buffer, was not successful. In any of the Euro area, the UK, or the United States, these buffers have not worked to reduce deleveraging pressures. Also, communication needs to emphasize that as you release the buffer, you essentially tell banks that the buffer will not be rebuilt for a considerable length of time to make it so that banks have confidence in dipping into these buffers. The social costs, on the other hand, of releasable buffers need not be, the social costs of building buffers can be quite low. This isn't well understood because building buffers is invariably opposed by shareholders and by extension industry lobbyists, since larger capital buffers, even if they hold constant the value of the bank as a whole, they always will tend to shift some of that value towards bondholders and depositors and away from shareholders. So there is a distributional effect that goes against shareholders, which makes them oppose buffer increases. On the other hand, there is little evidence that larger capital buffers compromise steady state lending growth. And that's because, again, the increases in the weighted average cost of funding for the bank and therefore increases in loan rates are typically very small. Short-term adjustment costs are well documented, however, and we need to take care of those. So the reduction in lending from building those buffers, though, can be small if we are careful that banks are profitable, allowing them to build the buffer from retained earnings, and by being careful to gradually increase buffers, or if banks have voluntary buffers that they can use to meet the requirements. How to assess the size of these neutral buffers? That can be done qualitatively, first off, and that can key off the existence of stock vulnerabilities. So if a country has high leverage or debt service is sensitive to variations in interest rates from variable rate mortgages, say, or sensitive to changes in exchange rates from FX-denominated debt, for instance, this creates stock vulnerabilities that argue for higher neutral rates. Also, exposure to external shocks can be relevant for many open economies with a potential for capital to flow out of the country, again arguing for higher neutral rates. Pegged exchange rates also argue for higher neutral rates because under a pegged exchange rate, you will not have as much room for monetary accommodation in periods of stress. The effect of such stock vulnerabilities on losses can also be assessed quantitatively using solvency stress tests under moderate to adverse scenarios. And we have started to do these kind of exercises in our FSUP program. The France FSUP is a good example. As you consider the size of the buffer, you want to be sure, though, that the buffer exceeds the losses that will come in under the stress scenario, so that banks, even after the release, have some capital left to make them confident to continue lending to the economy. I promised to say something about advanced economies versus EMs. So the upshot of this chart is that neutral rates can be as useful for emerging market economies as they are for advanced economies. On the top of this chart, you see for advanced economies, the losses that they sustain in systemic banking crises typically are conditional on how much how fast credit growth was in the run-up to the systemic crisis. So the right-hand bar shows you that crises that were preceded by high credit growth in advanced economies generate larger losses relative to crises that weren't preceded by high credit growth. This argues exactly for a neutral rate that you can build on as credit growth grows more strongly. This pattern is different though for EMEs, where you do not find that the losses sustained in systemic crises is sensitive to whether or not credit was growing strongly ahead of the crisis. So that argues for emerging market economies for the neutral rate to be a sizable component of the overall framework. Just very briefly on the relationship with other buffer requirements, we think that sectoral releasable buffers, such as the systemic risk buffer that's in place in Germany, for instance, on real estate exposures, are a useful complement to broad-based buffers. The advantage of a sectoral buffer is that it can provide incentives to shift away from specific risky exposures, but it may not protect as well against the range of possible shocks, so that we may need a broad-based buffer such as the CCYB in addition. Finally, in many countries, Pillar 2 capital buffers are in place. Our thinking here is that those buffers are not a good substitute for releasable buffers, but you can have some of that Pillar 2 element put on top of the releasable buffer. In many jurisdictions, including within the euro area and also in the United States, the Pillar 2 buffer requirements are driven in part by macro-financial stress tests that are conducted every year. We think these tests do well to assume the release of the CCYB and other releasable buffers, in that exercise. A positive, if you have both the releasable CCYB and the Pillar 2 buffer, this would ensure that you avoid double counting, having basically two capital buffer requirements ensuring against the same thing. And the remaining Pillar 2 buffer, of course, you can put on top to account for some heterogeneity that you may still have across banks. So we want to avoid double counting here, basically. So with that, I conclude. Maintaining a share of overall capital as a releasable buffer, either broad-based or sectoral, helps better prepare for adverse shocks. Releases should condition on whether capital buffers are becoming a binding constraint on the provision of credit. The activity towards neutral levels should start as soon as profitability or voluntary buffers allow. Increases beyond that neutral level are possible based on indications of increases in risks. Positive neutral levels of releasable capital should be considered in both advanced and emerging economies, and their size should reflect stock vulnerabilities and exposure to external shocks, and can also be quantified using stress tests.
Well, excellent. Thank you very much, Erland. We'll go straight to Cornelia. I think she has also prepared some slides. And in the meantime, we already have 2 questions, so I wanted to remind the participants you can post questions in the Q&A tool. You can even vote on questions if you want to do that, if you just want to join another question. So, Cornelia.
Thank you. So I hope you can still hear me and you can see my slides. Very
Excellent.
good. Very good.
We can hear you very well. We can see the slides very well.
So thanks very much also to Erland for this excellent paper. I must say you put me in a difficult position because a lot of the things that you write in the paper, me and my colleagues here, we really agree on the main gist. So yeah, it was hard to find a really good criticism of the paper, and that's of course what you're looking for in a seminar like this. Let me say that the views here are basically my own, but the colleagues that are listed here at the bottom of the slide and the various publications that the ECB has already published on this topic, they of course helped to shape this debate. So let me just very quickly start with a summary of the paper. So the context is that, yeah, the COVID crisis, they exposed that there are really limits of in the way that the countercyclical capital buffer frameworks were helpful at that point in time, at least in the euro area. So I always talk now with the experience here from the European countries. The limit, the amount of releasable buffers were really limited at the onset of the pandemic. So hardly anything could be released at that point in time. And there was a good lesson, I think, because we had to start thinking how to ensure releasable capital in crisis, even if we don't have a prior credit boom. So what this paper very usefully does, it reviews the post-great financial crisis and COVID experience with the capital buffers. It does a cost-benefit analysis of a positive neutral CCYB. Or as we also like to call it, rather an early activation of the CCYB, as I noted that Erland also switches a bit between the two terminologies. And it proposes an operational framework for building, calibrating, and releasing the countercyclical capital buffers. And the main takeaways here are that the paper supports the setting of a positive CCYB in normal times to ensure availability of the releasable buffer, that these buffers enhance their resilience, even if crises have not been preceded by excessive credit growth, and that actually the build-up costs of these buffers are moderate, especially if they're phased in gradually and when, of course, banking sector conditions are favorable. So let me come to my general comment. So I really think it's a highly policy relevant topic, and in particular, there are many discussions on macroprudential reforms ongoing right now. And there is a central challenge in macroprudential policy. I think in principle, there's broad agreement that buffers are beneficial because they can be drawn down in crisis times to support the real economy. That also then signals strength. But how to ensure that banks have enough releasable buffers to be used? Because politically, it's not so easy to implement them. Yeah, so it took several years to get them into national law here in the euro area. Each country at its own pace, because it's basically a national tools whereby the ECB has some topping or powers here, and there's a strong inaction bias here, and that's clear because in the authorities that do these that take the decisions on these measures. Yeah, sometimes they are central banks, sometimes supervisors, but it's also the finance ministries that are very often involved. So it gets very easily political. You can imagine, especially on the borrowing measure side, but also the capital measures. Here, the banks lobby extensively when it's time to increase these buffers. So it's a hard political task to actually increase them. So the paper discusses in quite some detail pros and cons of setting this positive neutral CCYB rate, and also talks about its design, the release dynamics and communication strategy. And we believe that this analysis is really quite convincing, and it shows that the traditional activation approaches often lead to insufficient buildup of capital buffers. So it's good to take a new look at it. And I cite here a number of recent ECB papers because my colleagues have also been quite active on this topic. So we will share all of these later on. So I will focus on some of the key aspects that are addressed in the paper: the design, objectives, implementation considerations, legal ones, and then some thoughts about the time on the release. So first of all, on the design, the paper presents the positive neutral rate as a baseline level of releasable capital in normal times. And to us, this suggests a rather structural interpretation, whereas the ECB's view is more that the CCYB would really remain a risk-sensitive instrument. That's also why we would rather use the term standard risk environment rather than neutral risk environment. The emphasis on the early activation in the buffer and in an environment where we see that cyclical systemic risks are neither subdued nor elevated is where we put the emphasis here. And again, I give you a reference where we elaborate on this more. And this, I think, also helps to sell the concept to outsiders. We thought that the paper could better clarify the use of the buffer through the cycle. And Erland, you started on the right-hand side, and this is also probably where I would question. So you have this partial release here, and I wonder how that should really work. I mean, if I think of a crisis time, of a crisis situation, the COVID shock is, of course, a very important one, but also the great financial crisis. How would you think about having a partial release? I think either you think you are in a really troublesome situation where lending to the real sector, there's a fear that it's stalled completely or not. So I would find it really difficult to calibrate the partial release. And in particular, because a lot of these theoretical concepts behind the level of the CCYB, we don't probably have the data at that point in time. So I wonder how you would tackle this. So this is probably the aspect that I've found most puzzling. Then my second comment is on the objective. So in line with this interpretation that we perceive as being more structural, the paper presents this positive neutral rate as an insurance against a quite broad range of shocks. And this would include some that are actually unrelated to the credit cycle. So some of the primary objectives of this positive neutral rate is that capital is available at all times, and also to very broadly increase the resilience against a wider spectrum of shocks, including against exogenous shocks. Whereas here in the ECB and ESRB side, in our report that we published last year, we emphasize some additional objectives of an early activation approach that maybe you could consider also for your paper. So really the timely activation of the CCYB, the gradual buildup of the buffer that limits costs. I mean, I realize you discussed this to some extent, but we thought this is really for us. We would like to put more emphasis on this, and then also the uncertainty in the identification of the cyclical risks and lags in the measurement. And again, that might lead to under calibration of the buffer. In particular, in the European Union, we always have a 12-month lag. No, so whenever an authority decides to increase the buffer, the banks have basically 12 months to adjust to the situation. So there's already it's a slow procedure. Let me come to some implementation considerations. So you highlight that there are really very different approaches adopted worldwide to the setting of the rate. And here is some illustration of that for European countries, where you see there's quite some heterogeneity, both in the levels that currently apply, but also, and these are the red dots, in the target positive neutral rate. So really, yeah, it's all over the place, no, between 0.5 and up to 2%. So these differences that we see in Europe reflect differences in calibration methodologies, but also in policy motivations and the scope of the instruments. So I would find it interesting also if your paper could further discuss potential benefits of a more harmonized application across jurisdictions. Because I imagine that, globally the differences are even larger, and in our view, greater consistency could be beneficial for transparency, predictability, cross-country comparability, and policy communication. Point 4 would be some legal considerations that we thought it could be interesting to address some of the legal aspects that are around the early activation of the CCYB. Because this rather new Basel Committee approach is not yet enshrined in many of the international standards. And what we see in Europe, for instance, is that, legal clarity is not really there yet. There are lots of different views across countries on the legal feasibility of activating the positive rate in the absence of excessive credit growth. So sometimes there are different interpretations of the rules or different transpositions into national law. And it's sometimes we have odd situations that really these buffers are implemented in very, very different ways, and there's a need for more harmonization, and I think this is very widely accepted. Some final thoughts about the timing of the release. You rightly say that it's really crucial to ensure that these releases support lending in a stress episode. So it would be interesting to have a more detailed discussion of the consequences of being either too early or too late when releasing the buffer. So some implications, for instance, of releasing too early. And again, there will always be pressure from the banking sector to release too early, is that in the end, the banks may not use these releases to sustain more credit supply, but do other things, increase dividend payout or share buybacks. And this, I think, is something we have seen in the past. So I think there would be an interesting further thoughts. So let me conclude with these considerations. So we do think that these early activation approaches help that the CCYB can be useful in this counter-cyclical sense. And in our view, it should remain a cyclical, risk-sensitive instrument. And here, clarity on design and release mechanisms, it's essential to preserve also their credibility and a greater consistency and the application across the jurisdiction would be beneficial to enhance transparency, predictability, and cross-country comparability. And we see this especially in the EU context. So this paper, I think, is very useful in explaining the issues that are related to the CCYB, how the early activation helps, and how it proposes ways to build and calibrate and release the CCYB. I should say, and my very final remark, increasing buffers at this second, it's not en vogue, no? So the debate currently, the policy debate, at least the one that we're facing in Europe, but I think elsewhere also, it's shaped by the push to modernize or simplify the regulatory framework. And banks are using this debate to heavily lobby for deregulation, meaning lower buffers. And so it's a hard time to argue for higher or for any CCYBs or for an early activation of these in the public sphere. So a paper like this really helps to provide argumentation and to provide evidence of the rather low costs of building these buffers in current times. Thanks very much for a good paper, Arnold.
Thank you, Cornelia. That was great. So Steve, we're keen to hear from you too.
Thanks very much. So first of all, I guess I should say that something that Volker didn't say in the introduction is that I'm a member of the European Systemic Risk Board and the vice chair of the Advisory Scientific Committee. So
Thank you.
The important thing about that is that we have responsibility, at least at the margins, for some of these things inside of the EU. And but let me also just mention that, of course, Erlen and I have known each other for quite a long time at this point, and I've always enjoyed our discussions, which I think border on arguments most of the time. They're very fruitful, and I learned from it, and I learned from this paper as well. And I want to thank him for including me in this. I received the invitation from Erlen because he knew, I think, in advance that I would not be very positive. And so the question was, what is it that I was going to say about this? And I want to pick up on some of the things that Cornelia said near the end about some of the problems. I'm going to, in the interest of time, I'm going to ignore this. I think that this slide, which Erlen did a terrific job. So the question I have is really about whether we should try and save the CCYB. And I think that the first thing is that the Basel III credit gap analysis was destined to failure from the beginning. And I won't go into the technicalities of that. I was never a big fan of this. I've never been a big fan of the CCYB itself, but I've certainly been very critical of the use of the credit gap. The credit gap doesn't make any sense to me at all because it says nothing about the level, only about the relative level. And if things trend higher, then the credit gap doesn't change, but the vulnerabilities clearly increase. The second point I have is about the bank behavior. Regulation, in my view, tends to bind in upturns. When things are going well, regulation tells people to stop. When things are going badly, it's markets and risk managers that tell people to stop. And so I think that's a very important point to keep in mind, and it's related to the question of whether or not banks are actually going to lend in these circumstances, or it is which banks, as I'll talk about in a moment. There's no evidence, in my view, that higher capital requirements result in lower lending, and by analogy, there's no evidence that lower capital requirements result in more lending. So there's also no evidence that I know of that creditworthy borrowers are unable to find funding during periods of stress. Now, so it's my view is that its resilience is structural, and we should be thinking about structures, not time varying. Now, what is it that would mean for a buffer to be usable? I hate this term usable because, of course, it implies that capital is somehow idle. It's not. It's being used. So there are a bunch of things that you would need. The first thing is that CET1, which is to say Common Equity Tier 1, is not binding, rather than alternatives like these resolution requirement things. Those do seem to bind as far as I can tell, at least in the EU data that I've seen for roughly 300 banks. They're bound by MREL. They're not bound by risk-weighted capital requirements. You don't in order to reduce and to increase your lending, you have to make sure that you're not running into payout restrictions. Cornelia mentioned the fact that people might actually pay this out, so you're actually relaxing the payout restrictions possibly. It has to be large enough to absorb realistic shocks and to pass both internal and supervisory stress tests. And the main thing is that there has to be a willingness to increase liabilities to lend. Remember, when you relax capital requirements, what you do is you tell people that they can increase their liabilities. Now, all of their capital and other liabilities are currently engaged in lending and other activities. So will they now increase their lending by somehow attracting more liabilities? I don't know. Now, I have a couple pieces of information to show you. The first one, which I find this very striking, just as for the U.S., and I have not drawn this for other countries, but other people have done this, so there's similar sorts of things. The important thing about this is that the credit that's coming from the credit to the non-financial sector to banks relative to total credit to the non-financial sector in the U.S., so the fraction of that's for which banks are responsible, has been roughly constant since the early 2000s. I find this astounding because, of course, capital requirements in the early 2000s in the US were pretty close to zero on a Basel compliant 3 equivalent basis, and they're not zero anymore. So capital requirements have gone up massively at the same time that bank importance in lending has been unchanged. The second thing is that if I just look at the net worth as a fraction of total assets for the banking system in the US and lending as a fraction of total assets, it's actually positively related. So higher capital funding does not mean less lending. And the reason is that there's a capacity to lend in bad times, and there's a willingness to lend to healthy borrowers in good times. So how can lower capital requirements mean more lending if higher capital requirements, if higher capital levels mean less lending? Mean more lending. The third thing is that I think that, and this was something that Cornelia covered, I'll be very quick, time-varying capital requirements have tremendously difficult implementation problems. There are information problems, there's transmission lags, there are political economy problems with credible commitment, and there are cross-border spillovers. I realize that there are these reciprocity rules, but they may or may not be working, especially for borrowers that are running multinational firms. So unilateral action invites regulatory arbitrage, et cetera. Now, this is an interesting one because I happen to have data for the EU banks this is for about the 100 biggest banks. It's a change in and I can look at the change in bank capital and plot it against changes in the CCYB from 2021 to 2024. And the changes in capital here are the changes in the Tier 1 risk-weighted requirement. And so that's what I plot on the horizontal axis, and on the vertical axis is the change in the CCYB. So there were a lot of increases. 2021, remember, was at basically the tail end in this case of the pandemic. And so since then, there have been a lot of increases in the CCYB. And the question is whether people have been increasing their Tier 1 capital as the CCYB went up. And the answer is no. And in fact, it basically goes the other way. It's pretty much uncorrelated in any reasonable way. So the other thing to think about is when you increase the CCYB or decrease it, what you do is you give headroom to the weakest banks. Those are the banks that are close to the requirement. They're not the strongest banks, they're the weakest banks. So do you want to give an incentive for the weakest banks to lend in order to reduce the cyclicality? So what should we do, in my view? The answer I have is you require more structural capital. It's higher, simpler, and always there. You use stress tests, not credit gaps. I believe that's right, but to calibrate requirements. But these are for structural requirements. And you apply resilience standards universally, including to non-banks, but you have to coordinate internationally, which has now become a problem. So instead of rethinking, I would reconsider macroprudential buffers. It's a word that's an English word that sounds the same but means something quite different. In my view, the CCYB is unlikely to work in practice, except for possibly to encourage weak banks to lend to weak borrowers. It's hard to see how buffers can be usable, and I think there's some interesting work on that, which suggests that in the EU they're not that usable. I agree that a positive neutral CCYB is an improvement, but only if it's additive. The paper is actually clear about this and does not offset other requirements. There's been a move in the EU for the positive neutral CCYB to be what is called capital neutral, which means that you reduce other buffers in order to increase this one. I think that's a terrible idea. But what works, in my view, is structural robustness. Banks always need more equity. If I look back at the SVB episode was not one where you needed a CCYB, but where you just needed more equity. And with that, let me finish and leave some time for our discussion. Thank you very much.
All right, Steve, thank you. That was excellent. Thank you for raising these important points and criticisms. Maybe let's go like this. Let's have Erla maybe respond to the two presentations, discussions, and then let maybe Cornelia also weigh in. She's been more supportive. Steve has raised more of the criticisms or argued more for the structural, non-time varying type of buffer. And let Steve respond, and then let's look at the 5 questions we have so far and have another round. So Erland.
Okay, so maybe I'll go to Steve's points before I go to Cornelia's. Thanks to both of them for their excellent discussions of the paper. The evidence that we review in the paper does not suggest that building the buffer is reducing credit growth or that much, in part because typically we're doing this when banks are profitable, when they're not really constrained by capital requirements. And so very likely increases in capital buffer requirements in good times aren't very effective in slowing things down.
Okay, so it seems we've have a little interruption with Erland there. Maybe he needs to dial in. Let's wait for him. But in the meantime, maybe Cornelia, you can respond a little bit to where you saw. I mean, you've been more supportive, so let's see how you view Steve's comments.
Yeah, I was happy that Stephen took a different approach. So that not that we all agree here. That would be a boring session. So I see you are more the structural type and don't believe so much in the cyclical nature. So I mean, I agree with you. Higher buffers. That's of course it's good. Higher capital requirements is good for banks. It shows resilience there. The whole system is better off. But I mean, we do have times when this doesn't hold, no? So I think that is really important that you have a cyclical element here, that you can release the buffers in bad times. And we have, I mean, I think one of the great lessons that we took from the great financial crisis, that this is really important. I mean, the COVID crisis, I mean, as I mentioned before, in Europe, we didn't have many macroprudential buffers. They were really minimal. So the most capital relief that was given at the time was given through the macroprudential buffer releases. But I find it really difficult also to interpret what was happening during that time, because there were so many relief measures all over the place coming from the monetary policy and the fiscal sides. So it's hard to really understand what was the effect of these releases. And in any case, on the macroprudential side, we know that they don't work as well as on the macroprudential one. But I really want to give back the floor to Erland now that he seems to be back.
Yeah, thanks. So I assume you already talked about evidence on releases. I do think overall there is some good evidence that when banks are under pressure and capital requirements become binding, it's useful to have a tool that can relieve that pressure. There is some good evidence around the GFC. Jimenez and others have found this to be the case. And again, in the COVID context, whereas I think it's not very clear that increasing capital buffer requirements in good times has much effect. That's true of the evidence in Jimenez and others that I mentioned, and more broadly, more recently. You are asking whether we should rescue or maintain the CCYB. I think our message here is that what's important is to have a releasable element in the capital structure. That can be a CCYB, it can be a sectoral buffer, it can also be a simpler buffer. I didn't talk about this much in the presentation, but it may well be that, for example, for emerging market economies, it's hard to find cyclical indicators that are reliable. For them, perhaps it's also not easy to use those from a political economy perspective. So then it could be useful for some countries like this to just have a simple releasable capital buffer that is set according to some stress test that can be done in those countries. And that is an improvement relative to a situation where typically nowadays these countries don't have any releasable capital at all. Maybe turning to Cornelia's points, first of all, I would like to, of course, recognize and acknowledge also all the work that the ECB has already done in this area. I think there is, agreement that still more work needs to be done in fleshing out some of the aspects. On the release, you asked about partial releases. Maybe this is overemphasized in the chart that we have in the paper. It's true, though, that in the COVID pandemic experience, a number of countries, including Norway, Hong Kong, and the Slovak Republic, opted for a partial release rather than a full release of the buffer. It's also those countries, though, that entered the stress periods with a lot of buffer. So all three of them had very high buffers to start with, around 2% or so, and they opted to only partially release maybe something like half of that buffer space in order to keep their powder dry, as it were, in the event stresses were to intensify in the future. And that can be a reasonable strategy that we wouldn't rule out. Of course, you wouldn't do that if your starting point is a half or 1% of buffer space. More broadly, I think it's important to be clear that we want the buffer release to essentially to offset pressure on capital that might otherwise come through in a crisis situation. And it's only if we're using the buffer in those kind of situations that we're likely to see much benefit of the release of the buffer. If you release the buffer outside of those stress periods, when the capital buffers aren't really binding on the banks, you're not as likely to see a response to credit growth. So that makes it also difficult, in part, to really ever be sure empirically of the benefits of the release, because it is conditional on doing this at the right time.
Thank you.
Leave it there. Yeah.
Steve, do you want to have a quick rejoinder, or?
I just have let me make two quick comments. I think that Cornelia mentioned the fact that during the pandemic, there were all these other programs. The question, I think, is whether or not, if you want to support lending, what's the best way to do it? Is this the best way to do it, or is it better to have fiscal and possibly central bank programs that subsidize lending? And I think it's especially true for sectoral programs. The other thing I just want to say is that I do agree with a number of the things that Erland has said. That wasn't my job. My job was, as I say, of the discussant is Mark Anthony's job. It's not to praise, but to bury the paper. But I will say that I am a big fan of things like capital conservation buffers, structural buffers that can be eaten away in certain circumstances with certain conditions that apply to them. The capital conservation one, which then comes with various restrictions on what the bank can do, I have always been a huge fan. Things that are like that, I think are really great. It's the time varying nature of the CCYB that I've always been troubled by. But anyway, thank you very much, and I think we're making progress. Let me put it that way.
Excellent. So let me highlight the 5 questions we have, and then have a response where, say, we start with Cornelia, then with Steve, then with Erland. Right. So one question here from Loriana Pelitzon here from Frankfurt: How can you ensure that if you release counter-cyclical capital requirements, banks will increase lending rather than use the freed up capital to pay dividends, right? It's related to things we've discussed, but more focused on dividends. Then we had here Mr. Mahmoud Metwali, who says, what are the most relevant factors that make non-releasable buffers, such as the capital conservation buffer, not as effective in times of stress. And what are the reasons? Is it stigma? Other things? Mr. Liu here, how should we trade off between the positive neutral buffer and with intermediation costs that come with it? And finally, one question, Arthur Gregorian, how would you recalibrate? How often should that periodic recalibration take place of the neutral rate? And Thomas Huertas, who says, why should these requirements apply only to banks? Maybe other non-banks which should be subjected to those buffers. So, Cornelia, do you want to start, and then Steve, and then Ellen that closes?
Sure. I mean, mindful that we ran out of time. Just on Loriana's point, no, I mentioned it also in the presentation. What to do, not how to ensure that the banks don't pay out dividends, and I think this is squarely the supervisor's job. So they have to engage with the banks and formulate certain expectations, and be in a dialogue with them. And I think to a large extent that also worked because indeed after the COVID crisis, I think there was a big push for banks to start paying out dividends also because it was then at the time when they were finally making more profits again. So, but it's a good point. And then there was a question on intermediation costs. I would say that the paper also argues, that these are actually quite low when you build them up gradually and in good times. So that's, I think, the argument you have to use. Let me stop here.
I'll be very quick. I agree on Loriana's question about payouts versus lending. On the trade-off, I think there's no trade-off at all. There's evidence that that better capitalized banks actually have lower funding rates and lower lending rates, and lend to better more high quality borrowers. So it's poor levels of capitalization are associated with high levels of funding costs and lending to poor quality borrowers. On the non-banks thing, I think we haven't worked this out yet, but we're still trying, and I think almost everyone would agree that we have to try and figure out how to treat non-banks if they're engaging in banking activities in the same way that we treat banks. But as I said, we haven't figured that out yet. I'll stop there. Thank you.
Thank you, Steve. Erland, any final comments?
Yeah, maybe I'll tackle a couple of points that weren't addressed yet. So why is it that banks don't want to use these non-releasable buffers, such as the capital conservation buffer, the stress capital buffer? The evidence really is that banks never dip into the space that's generated by these non-releasable buffers. And I think that has at least three reasons. One is, again, it's stigma, it's market discipline. Investors take a dim view of banks that are dipping into these supervisory buffers. The supervisor itself may exert pressure for banks to sort of re-emerge from using these supervisory buffers because, again, they're not actually released. They are still in place. And the third reason is that use of this buffer cannot really ever credibly make them available for any length of time, right? Because they're not actually being revoked. Banks must anticipate that the supervisor will start reinforcing them at any moment. So that's, those are the reasons that the banks really, basically start cutting lending as they approach the requirements that come from capital conservation buffers or stress capital buffers that are in place in the United States. So those buffers, again, we may like them for other reasons, but they're not the tool that can help with pro-cyclical bank lending. How often should we recalibrate neutral rates? I think the answer there is likely to be only rarely, right? That's the whole point, is to have something that you put in place You give banks some certainty. This is the neutral rate. If you move this around too often, banks will start seeing through some of this variation, and you lose the ability to really have traction when you need to release the buffer. So it's also conditioned on slow moving variables. Those stock vulnerabilities I was talking about may not move around or that much. Leverage, once it's built up, is going to be there for some time, arguing against very, very frequent recalibrations of the neutral rate. You can calibrate the cyclical part, of course, in light of changes in conditions. Then on banks and non-banks, my answer would be that it's very important to have these buffers on the banking system, in part because banks are the lender of, in a way, first resort for the provision of liquidity into the rest of the financial system, but also into the broader economy in periods of stress. At least that's true in many jurisdictions. So it's very important to have a tool that allows the banks to fulfill this role of providing liquidity into the economy in periods of stress, potentially, again, releasing capital buffers that would otherwise impede that provision of liquidity into the financial system, including non-banks, into the economy more broadly. So that argument we do not have for the NBFIs as much. The NBFIs do not have that role of providing first line liquidity into the system as a whole. And that's, I think, one of the reasons why we wouldn't push for equal treatment for NBFIs. NBFIs, though, would have to be subject to other macroprudential policy tools, certainly. In particular, if you're thinking about borrower-based tools that want to essentially discipline the types of lending that goes to households, to corporates, and so on, clearly those tools would have to be applied both to banks and to NBFIs in order to ensure a level playing field and in order to ensure that these tools work well in countering the buildup of leverage, let's say, in the household sector and in the corporate sector. So there is a difference here, a distinction between capital tools on the one hand and the borrower-based tools on the other that we do want to apply to the NBFIs as well.
Okay, great. So I think we have already topics for another webinar, but this was very instructive. I learned a lot. Also, thank you for the questions, and thank you, Erlen, Steve, and Cornelia for your contributions. We will post this very soon and spread the news and potential critiques, but certainly the need, I think we agreed on, well, generally there should be more capital, more equity, so in the banking system. And so that's another important message coming from here. So thank you and goodbye.
Bye.
Bye-bye. Thank you.
Thank you. Bye.